This is not the kind of equity market that many people enjoy. Whipsawed by headlines, claims and counterclaims, and geopolitics. Futures right now down 0.75% on the S&P. We're down almost 1% on the Nasdaq 100. On the Russell, we're down 0.9%. There's the opening bell. Switch up the board. A bid into the bond market. Yields lower by 4 or 5 basis points. A break to the downside of 199.45 on 10s. Euro dollar just a touch weaker, no drama here, basically unchanged at 113.67. Crude backing away. This is an interesting one this morning. We're down by 2.63% at $91.16. Pleased to say that Bloomberg's Anne-Marie is staying close with us this morning down in D.C. Anne-Marie, the latest, please.
The latest we have, Jonathan, is the president leaving the White House, departing, deciding to take a moment to speak to reporters, saying that the probability of a Russian invasion is, quote, very high. Those were his words. He's having the sense an invasion can happen in the next several days, and saying that every indication we have is that they are prepared to go into Ukraine. He also adds, likely, I imagine, a question from a reporter of whether or not he will pick up the phone to President Vladimir Putin. Right now, he says he has no plans, Jonathan, to do so.
AMH, that's the line from the president of the United States. You're familiar with the line from Russia. They say we've got no plans to invade Ukraine. You and I talked about this briefly about 20 minutes ago. I think it's worth going over again. What is the #1 line coming out of Ukraine?
So Ukraine is certainly in contact with all the Western allies and leaders. And while they agree that there is this mass Russian troops around their borders, this is something they say that they have lived with for almost a decade, Jonathan, especially when you see a lot of, his almost hysteria, but worry about what is going on in eastern Ukraine this morning. You and I both pointed out that this is an everyday occurrence in the Donbass region, notably in Luhansk and Donetsk. And both you have the Kremlin-backed separatists and the Ukrainian army saying the other side broke a ceasefire. The worry is, what if that was, as the United States is talking about, potentially Russia having a false flag operation? And the worry is that what kind of action in East Ukraine could potentially grow and metastasize into something much bigger. For Ukraine, Jonathan, the issue they have is they want to make sure they quell any nerves, because they are an economy that at the moment is a little bit on a shoestring. Right? They are still trying to develop their economy, and already we've seen capital, businesses, oligarchs leave the country because they are concerned. And what they want to do is make sure they can maintain an economy, because they're not sure how long this could last.
Anne-Marie, we've heard from a lot of people this morning, and we'll hear from Secretary Blinken in about 30 minutes at the UN right here in New York. The line that came from Jens Stoltenberg, the NATO Secretary General, got my attention, it got yours. He used this phrase, a new normal for European security. What did he mean by that?
He means a new normal of what if Russia were to continue amassing troops and maybe not invading, but leaving those troops there. I mean, Russia does have billions, north of $600 billion of reserves in the bank. You have oil prices trekking towards $100 a barrel, which is certainly going to lift the ruble. These are things that right now is on the side of President Vladimir Putin in terms of economically being able to withstand those troops out there, but something that Ukraine could not, Jonathan. This could potentially really drain the Ukrainian economy if this were to continue. And I think Jens Stoltenberg talking about this new normal is potentially this tit for tat between Russia and the West. And we should note, Jonathan, Russia has sent a letter with their proposals, Interfax is talking about, and one of those is about moving back those NATO forces.
AMH, thank you. The president making comments just moments ago. We have some feedback of that at the moment. Let's listen back to this so-called tape playback. These are comments from the president just a few minutes earlier.
The United Nations will make his statement today. He'll lay out what that path is. I've laid out a path to Putin as well on, I think, Sunday. And so there is a path. There is a way through this.
Are you going to call Putin? Will you speak to Putin? Are you going to call Putin?
I'm not calling Putin. I have no plans to call Putin right now.
Do you think he's made a final decision, sir?
The President of the United States making comments to reporters as he departs the White House to head to Ohio. The next comments we expect from the administration in about 25 minutes' time. We'll hear from Secretary Blinken at the UN here in New York on his way to Munich. In about 10 minutes' time, we'll catch up, touch base with Anne-Marie again down in D.C. and talk to Bloomberg's Maria Tadeo over in Brussels as well. For the market, about 4 minutes in, we're down by 0.75% on the S&P 500. Bottom of the pile, information technology, negative 1.2% for that sector. The energy, that industry group, down up by 0.2%. That's the price action. Let's get you some moves as well. Let's get to Abby.
Hey, John. Well, another macro factor influencing markets today beyond the geopolitical tensions, earnings. We have the shares of NVIDIA plunging the most in more than a year after they put up basically a lackluster quarter and guidance. Investors not impressed after rising about 30% into that. Palantir also plunging, a weak quarter in outlook. The operating margin missed. DoorDash, on the other hand, higher, record number of orders, 35% increase year over year as pandemic dining habits continue. And Walmart, the big one, up 1.4%, a very clean quarter, top and bottom line. Importantly, relative to supply chain issues, their cost of goods rose just fractionally. In addition, they built up enough inventories to hedge against rising company costs, and then the supply chain costs above estimates, but offset by some of the COVID easing in January, John. But Walmart is an early winner despite these geopolitical tensions. I should note, though, off the highs, and that could reflect those geopolitical tensions.
Abby, thank you. Patiently standing by, Peter Chair, Lori Calvasina, Jim Caron. Peter Chair, I wanted to come to you on the Federal Reserve as well and to talk about how all of this would influence the Fed's next move. Can I get your thoughts on that?
Yeah, I think whether we get 25 or 50 is up in the air. I could see it going either way. But I do think they're actually going to be fairly slow to move on the rate hiking side. They're going to want to give it time to see how it plays out. And I do think they keep mentioning the balance sheet reduction, and people seem to be dismissing it a little bit. I think that's going to be the big shock really to the system, and that's where you might see some stress on valuations, is if they really do proceed to aggressively move that balance sheet down, not just with runoff on the Treasury side, but actually selling some mortgage-backed securities. I don't think that is fully priced in yet, and that's one reason I think we keep seeing these huge gaps in valuations on these stocks that you just announced, all these large cap stocks moving 10%. Some of that's this fear of what does the world look like once we actually start seeing the Fed drain its balance sheet. So I think that's actually within a month or two going to be the bigger topic of conversation. People will pull back on this 5, 6, 7 rate hikes, focus a little bit more on short term, and then that balance sheet reduction. And Russia does play into this. I think we have to watch it very carefully. It will be disruptive to oil prices, so you can see that part being inflationary. But I think it's far more disruptive to the global economy. As we put in sanctions, that's going to hurt things. So I think the Fed will have to be very, very cautious in their rate hikes if Russia does do this limited incursion.
Pete, just on balance sheet reduction, where do you land on size? Bank of America have come out with some massive numbers. Mark Cabana was talking about $1 trillion reduction this year, another $1 trillion next year. Where do the numbers come from? What's guiding you?
Yeah. So we're coming out to something similar, that we think they go from almost $8 trillion to $5.5 trillion by the end of 2024. If they just start in June, Treasury runoff this year is about $500 billion, $800 billion each of the next 2 years. So you get a lot of that number just by letting Treasuries run off. If you do the mortgage runoff and some other assets, you get to that pretty quickly. And I think that's going to be the scale of this.
Looking at the equity side of things, Lori, your three buckets, cyclicals, secular growth, defensives. Amidst this conversation, what's guiding you to one over the other versus the other?
So look, our call for this year has been we wanted to be more oriented to the cyclicals in the first part of the year and pivot back to secular growth later in the year. And if you think about, sort of what we're going through right now, this crisis in Ukraine, oddly enough, is sort of stoking that cyclical side because we have commodity exposure there, which are one of the direct beneficiaries of the tensions. We also have, a pretty nice, sort of trajectory in financials right now. Interest rates are still rising. They typically do well ahead of the first Fed rate hikes. They lost their valuation appeal briefly, but now they're cheap again. So we're still riding our cyclical overweights for now. We do think there will be a time to get off those, but we're not there quite yet. We actually, frankly, John, we left our tech overweight on. And I stress that's not communication services, that's not internet names, but looking at classic sort of semis, hardware, software. We think you've pulled a lot of the valuation trough out, perhaps not all, but we are getting pretty darn close to pre-pandemic levels when we look at expensive stocks relative to cheap stocks. And we also think you have to keep in mind what's the bigger picture risk here from this more aggressive Fed, and it's the idea that it will cool the economy off. And typically when you see the economy transition from hot or above average back down to average type levels, that's when you want to move back into secular growth. So we feel like we are set up for a very, very choppy year. Frankly, I worry that the timetable is being accelerated just because the challenges to growth do seem bigger than they did at the start of the year. So the idea that we may get closer to that average trajectory, I think that timetable is getting pulled up and actually ends up proving the case for growth after you beat the heck out of them.
Jim Caron, I know that's a message that resonates with you. Everything that Lori just said on growth. Lori's looking towards the back end of this year. You're very focused on 2023. What are you focused on right now, Jim, on 2023?
So look, I mean, I think that we have to take this thing in steps. And right now we're in a position where fixed income is a very, very challenged asset class because interest rates are rising. We have the perfect storm of inflation that's going up and a policy that's being changed right now towards higher interest rates. But as we start to step through this, the first things that we can do is we can look at what sectors of the fixed income markets that are actually performing reasonably well. And those two sectors would be bank loans and also emerging markets local debt. Both have, reasonably high yields, and, whereas emerging market local debt is really a value proposition, bank loans are something that's going to give you some income and also protect you against higher rates. As long as growth stays reasonably good, we don't expect there to be a very, very big default cycle. So I still think that these are viable. The point here, though, is that as we look towards 2023, the value sector, the EM local debt side, I think is going to be one of the best performing asset classes within fixed income. It's got a lot of ground to make up. It has some of the highest real yields. It's got some of the best yields relative to credit rating and relative to duration. And many of the EM central banks have already hiked rates a lot last year, so they're later in their overall cycle. At some point, though, we are going to price in all of these rate hikes. Inflation's going to peak. It's going to start to roll over. And then I think there can be a rotation into more traditional high yield and even into some of the investment grade assets as well. But we do expect, at least in the near term, there's going to be some volatility, and I think you're going to get some buying opportunities. So while it's stressful right now, we do think that there is a nice buying opportunity that's brewing. It's sometime in March or April as far as I can time it, and I think that's when to do it.
Well, I hope that you'll give us the call first, Jim, and we can catch up. Peter Tchir, before you go, I wanted to give you the final word. For those in the audience that missed your introduction a little bit earlier, your company, Academy Securities, at the intersection between geopolitics and markets. You're surrounded at the firm by veterans, by former generals. Pete, can you tell me what you'll look for through the rest of today, with Secretary Blinken coming up in about 20 minutes' time?
I think it's us pushing back on Russia, and by announcing this intention to do the false flag, that Putin wants a pretext. He wants to be able to take that Donbass region and get away with it. He wants to be able to say, I helped the Russian people. They provoked me. I went in. I'm only doing something that the people in that region want. Please forgive me. Let's start fresh negotiations now that I control this region. So that's what I think he really wants. So we are pushing back, and by the more we can push back on things like highlighting false flag motives, it will be more difficult for him to take that step because there will be far more pushback. Despite Europe's desperate need for his energy, if it becomes very clear he's violated these people, this region, in a way that everyone becomes so uncomfortable with, that's when we will have that longer-term friction. And I think we've been doing a good job in this information warfare, right? There is as much information warfare as real warfare going on. And having said that, I think he has no interest in pushing in Kiev. And one of our generals pointed out just the other day that I think is really interesting. The Soviet Union and the U.S. actually never exchanged fire. So it's fairly unrealistic to think that he wants to do anything that puts U.S. citizens at risk, which would happen if he goes after Kiev. So I think keep this very focused on that Donbass region and figure out what that's going to mean. And part of that means to me that there are paths to, even if he gets his incursion, gets what he wants, that markets would get roiled briefly. But if we can get some settlement, life moves on, unfortunately, for the people in Ukraine, but probably good for the global economy.
Peter Tchir, wonderful, as always, to catch up with you. With Jim Carrington, Laurie Calvasina on this market, working through some big issues globally into the opening band and coming out the other side with equities just down a little bit. After hearing from the President of the United States saying the probability of a Russian invasion is, quote, very high.
It's very high.
Why?
It's very high because they have not moved any of their troops out. They've moved more troops in, number one. Number two, we have reason to believe that they are engaged in a false flag operation to have an excuse to go in. Every indication we have is they're prepared to go into Ukraine, attack Ukraine.
That's next. This is Bloomberg.
very high.
Why?
It's very high because they have not moved any of their troops out. They've moved more troops in, number one. Number two, we have reason to believe that they are engaged in a false flag operation to have an excuse to go in. Every indication we have is they're prepared to go into Ukraine, attack Ukraine.
The President of the United States just moments ago. Back with us, Maria Tadeo from Brussels. Down in D.C., Bloomberg's Anne-Marie. Anne-Marie, Secretary Blinken, 15 minutes away.
Yeah, we're reading those remarks from the U.S. Secretary Tony Blinken. Jonathan, as you say, he was on his way to Europe. That was supposed to be the plan today. But he's making this last-ditch stop in New York to address the UN Security Council and the U.S. Ambassador to the United Nations, saying this is why. Because what they see, their words, an imminent invasion potentially in Ukraine from Russia. This is why they want to spare no diplomatic potential olive branch to ease these tensions. Jonathan, I think it's important. We just heard from the President, but prior to the President speaking, we should look at the timeline. Last night, a U.S. official briefed reporters saying that what Russia said in terms of withdrawal was false, and they've actually added 7,000 troops, that 150,000 they had already put amassing around the Ukraine border. Then you have the Secretary of Defense, Lloyd Austin, at the NATO HQ in Brussels, where Maria is, and he is saying that they're seeing troops inch closer, more combat and support aircraft, as well as stocking up on blood supplies. And he says, you don't do this for no reason, and you certainly don't do them if you're getting ready for a pullback. So, Jonathan, there's a slew of U.S. officials coming out talking about and really ramping up the tension right now, and that is going to culminate with Tony Blinken at the UN. But we should note, Russia has sent their response to the United States, and they say they have no plans for an invasion, and they want to talk about security proposals.
That's the story so far. Really strong language from the United States. Russia denying any plans to invade Ukraine. Maria, we have to talk about Ukraine. What are the Ukrainians saying?
Well, look, Jonathan, every official that I've spoken with today in Brussels have told me that they are 100% focused on the situation overnight that happened in eastern Ukraine, where there are reports, again, a lot of this needs to be verified and it has to be independently checked, but there are reports which they're taking very seriously that a school was shelled overnight. Now, the concern here, of course, is that this is an area where it is very sensitive. Of course, we do see Ukrainian forces fighting with Russian-backed separatists, and they fear that anything in the next 48 hours that happens in that area could lead to potential escalation. If there's a military situation that happens in the Donbas area, if there is a military confrontation for the Europeans, that means is the end of the diplomatic way. That means that the Minsk deal, the Minsk Accord, you cannot carry that through, and essentially you're looking at a situation that looks very much like the scenario that the European Union really fears, which is fighting again in eastern Ukraine in a way that is much bigger on a scale compared to the 8-year war that we've seen over the past years. Of course, I will tell you this fighting is normal at times in eastern Ukraine, but the timing of this is very suspicious for the Europeans. Throughout these negotiations, I've told Vladimir Putin, escalation is not compatible with dialogue. We don't want to see anything happening in East Ukraine. This is a very hot point. It's a very tense situation. Do not do anything in eastern Ukraine. So they really are monitoring the situation that happened overnight, and they want to see specifically who fired what and what happened.
We've just heard from the Ukrainian Foreign Minister, who's just spoken to the British counterpart Liz Truss. They discussed the recent escalation. The Ukrainian Foreign Minister saying we spare no diplomatic effort to achieve peace. Anne-Marie, 10 minutes away. Secretary Blinken, just a final word from you, what you'll look for from the Secretary of State as he comes to New York and gets ready to go to Munich.
He's coming to New York, and he's going to be joining a number of individuals from the administration in Munich and in Europe. We should also note the Vice President of the United States is also heading to this Munich Security Council. You could see the effort, Jonathan, from the administration to try to reach a diplomatic path for this. And my question really, or what I'm going to be looking for from Secretary Antony Blinken, is if the U.S. says this is going to be imminent, and the Russians say they have no plans, what is the public face-saving off-ramp that the United States can now offer President Vladimir Putin, given the position he is at the moment?
Anne-Marie, important final words. AMH down in D.C., Maria Tadeo in Brussels. Fantastic team coverage. 21 minutes into this session, equities pulled back by more than 1% on the S&P 500. A bit into the bond market, these jitters filter through treasuries, yield to lower by 7 basis points to a break of 197 on 2, sub 150 at 148. Yields down at the front end of the curve by 3 basis points. With your sector price action, here's Kriti Gupta.
Well, good morning, John. Like you said, red on the screen, a lot of it driven by big tech. Specifically, NVIDIA is going to be your biggest weight on the S&P 500 after earnings that were actually pretty good, but investors' lofty expectations essentially weighing on that stock, and therefore the index broadly to the upside. Your one sole sector here is going to be energy. What's interesting, John, is that energy prices are actually lower today. Oil is lower today on the possibility of potentially more Iranian barrels on the market. Nevertheless, the underlying physical market is saying that demand is going to get higher and higher. Dated Brent barrels going to $100 a barrel. Once again, that's not the spot price, that is the dated Brent in the physical market. That's what's driving up the energy stocks in particular. Nevertheless, the other mover in this market is going to be Walmart after some pretty blockbuster earnings, one of your major index contributors to the upside, but of course, no competition when it comes to those big tech names.
Kriti, thank you. Kriti Gupta on the latest sector price action. Tons to work through. Whipsawed by headline after headline. This equity market heading lower. Up next on the program, we'll get to the trading diary from New York City this morning. Good morning. This is Bloomberg. "25 minutes into the session, this market whipsawed by headlines. Yesterday it was the Fed minutes. We were down 0.9%. We finished the session higher by almost 0.1%. Now we get taken lower by geopolitics, stuck between claims and counterclaims, disputes between the United States and Russia and Ukraine, trying to offer some guidance on a path forwards here. The next stop for this market, Secretary Blinken, moments away. Equities down by more than 1% on the S&P 500, the Russell, the Nasdaq. Your bond market has a bid. Yields drift lower, down by 7 basis points on 10s to 197 on 2s, sub 150. We were north of 160 a week ago. Right now 148.68. Yields head south by 3 basis points on the front end of the curve. That's the price action. Here's your trading diary. Secretary Blinken moments away at the UN here in New York at the top of the hour. We'll take that for you and bring you the headlines. The St. Louis Fed President Jim Bullard speaking at 11 Eastern. Cleveland Fed President Loretta Mester later in the day. The President discussing infrastructure at 12:15. More Fed speak to close out the week with Evans, Waller, Williams and Brainerd all on deck. And finally, the New York Stock Exchange will be closed on Monday for President's Day. From New York City, this was the countdown to the open. This is Bloomberg.
from the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Thursday, February 17th. Here are the top market stories we are following for you at this hour. Competing claims the U.S. says Russia appears to be moving toward an imminent invasion of Ukraine. The Kremlin begs to differ. Secretary of State Antony Blinken is set to address the UN Security Council in just minutes. Oil gets roiled. The commodity is at the mercy of geopolitics as traders weigh Russian risks against the potential return of Iranian supply. We'll take a closer look at crude's wild ride from pandemic lows to near $100 a barrel. And a win for Walmart. The retail giant tops estimates, gives a rosy outlook, and plans a $10 billion buyback, but says lingering high inflation and the end of fiscal stimulus pose risks. From New York, I'm Kaylee Lines with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, the focus once again on geopolitics, the headlines flying thick and fast this morning.
Yeah, what I'm really struggling with, though, Kaylee, is what is noise and what is signal. There is a lot of noise out there at the moment. The market is definitely struggling to interpret what is going on. I think investors are really struggling to price the risk here. Risk and uncertainty, two very different things. I think we've got a lot of uncertainty right now, very unquantifiable. So as a result, I think people are focusing on the energy market, as you say, maybe pricing out some possibility that the Fed goes 50. But beyond that, I think everybody really is struggling to get a handle on what is happening here. The provocation that is coming from Moscow is clear. The response from the West is also clear. Signs of unity, definitely working to diffuse the situation, but on the other hand, the Russians keep pushing, Putin keeps pushing, and the tactic seems to be from the West basically to flood the airwaves with an expectation of imminent action, trying to highlight and pinpoint what is happening, trying to maybe talk about the fact that an invasion is imminent, hoping to diffuse that very possibility. So many headlines crossing, and as I say, it's hard to figure out what the signal is. What is the noise? President Biden speaking on his way to Ohio a few minutes ago. We're going to hear from him a little bit later as well. This is what he had to say.
Very happy because they have not moved any of their troops out. They've moved more troops in, number one. Number two, we have reason to believe that they are engaged in a false flag operation to have an excuse to go in. Every indication we have is they're prepared to go into Ukraine, attack Ukraine.
Let's go to Washington. Let's bring in Bloomberg's Amory Hordern. Amory, what has changed in the last few hours?
Well, overnight, what we heard from a U.S. official briefing reporters was that the Kremlin's remarks that there was a withdrawal of some troops, they said that is false and that they actually added 7,000 to the number that they had was 150,000. And since that moment, Guy, we have heard a similar noise from other U.S. officials, from U.S. Defense Secretary Lloyd Austin over in Brussels. He's talking about the fact that they are now also seeing combat support, artillery support, even things like blood being moved closer to these troops to the border. And he says, when you have that happening, what kind of pretext and signal does that send? So you see what the U.S. is saying, and that just does not match up, though, from what Russia is saying. Russia has sent its 11-page response letter to the U.S. security proposals. They are saying that they have no plans to invade Ukraine. What they are looking for, what they say, is removing of all forces and weapons from Central, Eastern, and Southern Eastern Europe and the Baltic states, redrawing that NATO map. And that is where we stand right now. On the diplomacy front, Guy, we also should note there are a ton of headlines coming out of the Donbass region of eastern Ukraine, which you know has been fighting for the past 7 years. But we are seeing a number of reports from both the Kremlin-backed separatists and the Ukrainian military about who broke potentially this ceasefire agreement. Well, and could all of the conversation around that and what Russia is saying about the tensions in eastern Ukraine just be pretense? Should they actually take military action? You're saying, should Ukraine take military action, Russia take military action? At the moment, Kaylee, this region in the Donbass, this happens almost every single day, regularly, and we have yet to hear from an independent body on potentially who is to blame for this. What is so nervous, what it makes people nervous about seeing these kinds of headlines in this region on a day like today, which Maria has had a lot of reporting on from the officials she's talking to in Europe, is the fact that you are seeing heightened tensions with Russia and the West. And now you are having overnight a number of incursions in Eastern Europe between the separatists and the Ukrainian army, which does go on daily, but given the fact that it's coming on a day when you're seeing a flurry of diplomacy, it does raise eyebrows.
All right, Bloomberg's Anne-Marie Hordern, thank you so much. And we should note Anne-Marie will be talking to the Ukrainian ambassador to the U.S., Oksana Markova. You can see that on Balance of Power later today at noon New York time. And of course, we are also monitoring the UN Security Council meeting. It has just been called to session. Secretary of State Antony Blinken stopping by right here in New York City to address that meeting before he heads to Munich. So we will bring you those remarks from the U.S. Secretary of State as soon as they begin. But let's talk about the market implications of all of this and get to our question of the day. It relates to monetary policy and how geopolitics influence that, whether or not the Fed can move ahead with aggressive tightening in a scenario where you could be looking at a very unstable Eastern Europe. The question is, has Putin priced out 50 basis points from Powell? Let's get right to hopefully getting an answer with Vincent Signorella, Bloomberg macro strategist, as well as Ira Jersey, chief U.S. rate strategist for Bloomberg Intelligence. Ira, let's start with you. We've started to see a bit of pulling back on those bets on a 50 basis point rate hike next month. Is that due to geopolitics, or is it something to do with just a haven bid coming into the bond market and influencing the way these markets are priced?
Well, I think it's much more, it's a mix, right? So after the minutes yesterday, when there wasn't an additional kind of, impulse for the Federal Reserve to move 50 basis points, which I think some people thought maybe would be mentioned during, during that meeting, then we started to pull back. And obviously geopolitics will make the Federal Reserve maybe not move as aggressively anyway. We haven't thought, and I certainly haven't thought that the Fed was going to hike 50 basis points in March. I think the market's gotten a little bit ahead of itself because of, just Jim Bullard, the St. Louis Fed president, saying that he thought that they should go very aggressive. 50 basis point hike is not out of the question in the future, but I think as a first step, that's very unlike the Federal Reserve, who likes to do things a little bit more gradually.
Vince, how do you think the Fed is, though, thinking about the situation vis-a-vis Ukraine? Were there to be contact, were there to be fighting, I'm assuming that energy prices would go up relatively sharply, but you would also likely see a demand destruction story, particularly in Europe, and as a result of which global demand in aggregate would likely fall. How would the Fed manage that process? Because initially demand would come down, but potentially you could end up in a situation where energy prices remain elevated, therefore the inflationary impulse persists. How will the Fed be thinking about how to manage that story?
I think the Fed would have to look at the energy situation as a temporary phenomenon. Obviously, we wouldn't be, they can't price in that risk the way the markets can't really price in that risk. No one's going to be looking at this as an implication to World War III, so that this would be, fingers crossed at least, that this is not going to be something that's going to be a prolonged spike in crude, but rather just a temporary one. And I think the Fed will do what they're doing really right now. I couldn't agree with Ira more in that 50 basis points is a market getting ahead of itself, and there's absolutely no reason for the Fed to move too aggressively. I think it would undermine their credibility somewhat, make them look like or appear that a lot of the critics of the Fed are correct and that they're behind the curve. I think what we saw yesterday was indicative of where the market had overpriced. Even after the FOMC minutes, which many people are calling hawkish, I personally just didn't see it that way, you saw basically a quick steepening in the curves, and that was essentially a result of the shorter end of the curve repricing lower. In terms of yield. And I think that's a market looking at themselves and thinking they got ahead of themselves. So I think the Fed is fairly priced at the moment, maybe even actually too high priced in terms of rate hikes. But you make a good point. Political instability does reduce growth. It does cause issues with energy prices. But I think if they had to lean one way or the other, they lean towards a lower growth concern than they would lean towards higher energy prices.
Well, and of course, we will be hearing more from Fed officials throughout the coming days, including from Jim Bullard himself later on at 11 a.m. Eastern time. Ira, obviously, we are seeing some action in the bond market, some pulling back on yields. The 10-year yield now back down at 196. How high can yields go in an environment where the Fed may be moving toward tightening, but we also have geopolitical risks that the head of NATO had described as the new normal, where this could be a consistent problem? Does that keep some of the haven bid there and therefore cap how high yields can ultimately go?
Yeah, I think that's right, Kaylee. You know, one of the things that we have to consider when we look at the long end of the yield curve is we're not really thinking about what the Fed's going to do now, but where they're going to go to in the future. So when you think about the terminal rate pricing, right, that for me, when I look at the 10-year yield, that's going to be one of the two keys to, you know, how high we can get in terms of yield. You know, if using our models and just adjusting things for like good case scenarios where inflation comes down a little, but growth stays up and the Fed is able to hike to 2%, you're still only talking around 2.25% on the 10-year yield. So not too far above where we are now. So I wouldn't expect the long end to move much on the Fed. It's really, you know, where are we going to price that terminal rate that's going to move the 3-year, the 5-year note, and obviously the 2-year note is going to go right to wherever they're going to hike to. So you know, somewhere around 2% seems reasonable right now. And then for the 10-year, like you said, we will get flight to quality bids on occasion. And that's still true because even though yields are positive, say in places like Germany now, whereas they were negative, you know, for a better part of a decade, they're still, you know, our yields are still much higher. So we will continue to get bids from overseas where private investors, and we got some numbers just earlier this week from December, where foreign investors were still pretty reasonably big buyers of U.S. Treasuries, you know, as yields started to move up.
All right, we have to leave it there, but thanks so much for your insight. As always, Ira Jersey of Bloomberg Intelligence, as well as Vince Signorella of Bloomberg News. Now, coming up, fears of a war, concerns over high interest rates. How should investors react? We'll talk with UBS financial advisor Sarah Ponczek about where you should be putting your money. This is Bloomberg.
Earnings season continues.
The Metaverse to Spotify to Qualcomm and beyond.
Bloomberg is fastest with the numbers and analysis.
Peloton becoming a proxy for this pandemic.
I think there's tremendous opportunity.
Bloomberg, the fastest numbers and analysis you trust.
We are continuing to monitor all of the headlines crossing on the geopolitical front as it relates to Russia and Ukraine, and we are awaiting remarks from U.S. Secretary of State Antony Blinken at the UN Security Council. But we do want to talk more about the market implications of all of this and get back to our question of the day. Did Putin just take 50 basis points away from Powell. Joining us now is Sarah Ponczek, a financial advisor at UBS Private Wealth Management. Sarah, great to see you. When you think about what is going on the geopolitical front, how do you view the implications for the markets and for monetary policy?
Great to see you too, Kelly. So what we are seeing, the developments between Russia and Ukraine are no doubt concerning. They are unnerving. But at this point, the headlines are still very fluid. The situation is fluid. The headlines have just been flowing fast and furious, which clearly has been bleeding into volatility as we are seeing this morning in the markets. But if you look historically, typically geopolitical shocks like this, the effects on diversified portfolios are relatively short term. And I would also bring it back to your question of the day. What does this mean for the Federal Reserve? You know, at this point, I'm not so sure it has a direct effect on the Federal Reserve's reaction function, because the Fed is very much focused on their dual mandate, so maximum employment and price stability, with inflation very much in the hot seat. No pun intended there. But with the way that data has continued to come out, market-based measures of what the Fed is expected to do. Yes, market-based expectations of a 50 basis point hike have come down, but at UBS, the expectation all along has been that the Fed will more so take a gradual pace, and we'll see them kick things off with a 25 basis point hike starting in March, and that by the end of the year, we could see 150 basis points of rate hikes, which of course has implications for investors.
Sarah, morning, it's Guy. Let me come at this from a different angle. Investors are using energy as a hedge against inflation, which comes back to the Fed story, but let's focus on the inflation aspect. It looks also as if that could be a good hedge against the geopolitical risk as well. Is that where the Venn diagram overlaps the most?
Likely, when we think about how you could potentially hedge geopolitical risk, yes, energy is probably at the top of that list, as we have seen for other reasons too. Oil prices up about 20% this year already. Energy stocks up about 20% this year already. Energy and financials are the only two sectors in the green in the United States. But you can also just think about making sure you have a geographically diversified portfolio. Even though, yes, maybe U.S. stocks have been in the lead for quite a while now, the expectation has been that value international stocks are going to outperform. That includes developed international, including Europe. But at the same time, you want to make sure you're not leaning too much into any one basket, because as we've seen, if geopolitical risks come to the forefront, which really no one can expect, that can weigh on one geographic sector in particular.
So that's if you're going to stay invested where you think you should put your money, Sarah. Are you having clients coming to you and saying, hey, I think I might want to go to cash? And what do you tell them if they do so?
It's been an interesting conversation to be had really over the past few months, and not just because of the volatility in the markets that we have seen this year, but because of the expectation of rising interest rates. Still, though, I would point out today, for example, when we do see volatility in the markets, for once in a while, we actually are seeing the bond market act as a ballast. We are seeing yields come down for once after the sharp increase that we have seen this year. But cash really over history has not been a great place to park your money, especially when you're talking about inflation rates above 7%. So the question becomes, where do you go? At least in fixed income, it makes sense to diversify a little bit and maybe look at instruments with floating rate structures, whether that's senior loans or private credit, if you can handle the illiquidity of that.
Sarah, one thing cash does give you, though, is optionality, the option to take advantage of situations. How do I get that if I don't have cash?
So if you don't have cash, you can still have optionality if you have liquidity. So, for example, I just mentioned private credit. Yes, if you're invested in private credit, you can't liquidate and have that cash available within a day or two to then redeploy. But if you still remain in liquid areas of the market, then you still have relative optionality, because it's not as though you can't rebalance a portfolio or sell out of bond positions to then reallocate to stocks. So there still are ways to have optionality without just sitting in cash over the long term, because as we all know, it is very, very, very difficult to time markets.
And Sarah, in this, you talked about bonds kind of acting as a ballast. When do rates become more disruptive to equities? Because we got to that 2% threshold, which seems like it may be a problem. It didn't necessarily turn out to be for rates in and of themselves. How high can yields go before it starts to threaten TINA?
So if you look at the data, typically it really has been the rate of the rise in interest rates that could be disruptive to equities if they rise too fast, too quickly. It's not so much the level, particularly when we are talking about still historically low interest rates. 2%, yes, maybe it is a psychological threshold because it is a round number. But we expect that equities will be able to re-rate and digest a grind higher in interest rates from here. Still at 2% on the 10-year, the market's already pricing in 6 rate hikes by the Federal Reserve. So the expectation is not that we are going to see another very swift major increase higher in the bond market, and that should be something that the stock market can handle, especially when fundamentals are so strong. I mean, we're coming off of a very strong earnings season, 26% year-over-year growth for S&P 500 companies, and we still do expect corporate fundamentals to remain strong through the remainder of the year.
Sarah, great to catch you up. Great to see you. Thank you for your time. Sarah Ponczek, UBS Private Wealth Management. Thank you very much indeed. Okay, what do we got coming up for you? Palantir taking a tumble. Today's software maker came out with earnings that again show profits are elusive. The stock, as you can see, down heavily over 2 days. On the session, it's down by nearly 12%. More on that next. This is Bloomberg.
This is Bloomberg.
A couple of big tech names, one in software, one in hardware, taking a tumble today. NVIDIA and Palantir out with earnings, both disappointing to the downside. With us to work through the numbers, Mandeep Singh of Bloomberg Intelligence. Mandeep, let me start with NVIDIA and figure out what is going on there. These numbers don't look that bad, and the Jaguar Land Rover story I think looks interesting, but I guess coming into this, you've got a pretty top evaluation.
Yes, and it was really about beat and raise, and by how much. Clearly they did that, but not by the same magnitude, they were doing in the recent period. So look, I think there is that supply chain risk that investors care about. There is clearly a lot of demand for what they are making, both on the gaming side as well as the data center side. The question is, can they fulfill that demand? And the other is, how much of the cost does NVIDIA has to pay to somebody like TSMC to make those chips? Because we know TSMC is raising prices. And that is why I think there could be some gross margin pressure in the near term.
Well, and of course, NVIDIA has to move forward without ARM because that deal fell through. What do they do next?
Well, so they have plenty of, large end markets. On the automotive side, even though automotive is small, they talked about how autonomous driving could be a big end market. And look, when you compare NVIDIA to somebody like, Intel or Qualcomm, Intel really was big on the CPU side, Qualcomm on the mobile processor side. NVIDIA has really captured the market on the AI workload side, and there is a distant second in AMD, but they're clearly running away with the market, and that's where all the demand is right now.
Let's talk about Palantir, a software company trying to pivot to Europe, trying to pivot out of government, trying to pivot to corporate. They're bulking up as a result in terms of the sales teams, in terms of the operational teams to try and make that happen. The stock's been kind of on a downward trajectory for a while now, Mandeep. Talk me through today's numbers. As I say, they're trying to bulk up, they're trying to make this pivot, but I guess in the near term, well, maybe not even in the near term, that continues to pressure margins.
Yes, clearly. And look, when you have got a handful of customers, albeit, these are 6 million average revenue customers, large governments, high retention. But the question that investors have is right now, the analytics space is growing very fast, north of 20%. Why is Palantir not participating in that growth? And the reason is, one, they don't have a sales force, so they'll be spending on that. The other is just their product doesn't lend itself to, a small or a mid-sized business. And that is where there are question marks about the sustainability of their top-line growth.
All right, thank you so much for joining us with the latest on both of these companies. Mandeep Singh of Bloomberg Intelligence, appreciate it. And I would note NVIDIA, obviously a very large heavyweight in this U.S. equity market. It is a big responsibility for why we are seeing stocks down pretty hard today, 1.7%. Of course, geopolitical risk has something to do with that decline we are seeing on the NASDAQ 100. Of course, it's a better story for some other stocks, though, and it was a surprising report from Walmart. Quarterly earnings topped expectations. We'll discuss it with Stephanie Wissink, Jefferies Managing Director and Senior Analyst. That's coming up next. This is Bloomberg. We're about an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, we are right around session lows.
We are right around session lows, and in a classic risk-off day, we have that S&P 500 down about 1.5%. Right now, down on the week, not by a lot, but nonetheless, a decline on the week. Most major indexes down more than 1%. The VIX is popping higher. That fear gauge, not wildly higher, but nonetheless at a 27. Gold, that old standby haven, it is also higher, up more than 1%. And then you can see the dollar against the yen is dropping as there's demand for the haven yen, but probably the haven most closely watched bonds. We have a decent rally right across the curve. In particular, the 10-year yield over the last 2 days is falling. That, of course, tells you that bonds are climbing. So this 10-year yield over the last 2 days creeping back from down below 2% right now, losing 8 basis points. So against the backdrop of these expectations of a hawkish Fed, that speaks to the degree of a haven demand. Now, beneath the surface, Kelly earlier was mentioning NVIDIA, so let's take a look at what's working and what's not. The worst stock for the S&P 500, Albemarle, the lithium producer, not a great quarter, and also more importantly, the forecast margins under pressure. A similar situation for NVIDIA. They actually beat estimates, but the high expectations led investors to be disappointed here. Plus, you have the outlook not as quite as good as folks were hoping. So that stock is down 8.4%, one of the biggest weights on the S&P 500. To the upside, though, Cisco up 3.8%, a good quarter. Also, their third quarter outlook up a little bit more. The growth, I believe, up 5% as opposed to 3%. That's a bellwether on IT spending, so that might be a positive sign there. And then Walmart, a great quarter, solid quarter, I should say, really managing supply chain constraints. As for one of the other commodities and assets that's really a tell on the geopolitical tensions, oil, because of course we have these geopolitical tensions rising again in these up and down days. It's really shown here by oil. Last Friday, when tensions escalated, you can see oil popping. I think it was up about 5% that day, and then down, up. And right now, on the day, we are actually down, which may suggest that some oil traders are a little bit less concerned about these geopolitical tensions between Ukraine and Russia, Guy. On the other hand, on the week, up 2%, so that would speak to those tensions. Another interesting time period to look at markets.
Absolutely. I have to say, though, I'm slightly struggling to read too much into the price action here. You've got a U.S. holiday Monday. Volumes don't look particularly good right now. A lot of noise out there, not a lot of signal. I just wonder whether a lot of traders are retreating to the sidelines, just waiting to see if the dust settles, if we get a clearer idea so we can start pricing things maybe a little bit more accurately. Abigail, thank you very much indeed. Abigail bringing up some of the more interesting stocks out there. NVIDIA, as she says, the biggest drag on the S&P right now. Cisco, the biggest upside in terms of the points performance, then Amazon, then we get to Walmart. Walmart stock currently up by 2.34%. It's certainly adding to the upside for the S&P, which, as Abigail says, is at session lows. Beat expectations. It's talking about consumer sentiment being fairly okay. In some ways, this is a company with scale to be able to deal with the supply chain stories that are out there, and it's certainly demonstrating that. Here with her take, Stephanie Wissink, Jefferies managing director and senior analyst. She has a buy rating and a price target of 184 on the stock. Stephanie, let's just talk about this business. It has such scale, such heft, that when others are struggling with supply chains, it is not. That is a huge advantage right now.
Yeah, clearly it's a huge advantage. And I think in this backdrop, it's also a